Welcome to the Market Mosaic, where every week we are looking at the intersection of macroeconomic data, stock market technicals, and market internals, things like breadth and sentiment, to try to figure out where the market could be headed over the near term. For investors, there's a lot of geopolitical developments to contend with. So a lot of things making the headlines. We had the pivotal Supreme Court ruling on tariffs. We have the ongoing buildup of military forces in the Middle East. So these are some of the things that are confronting investors right now. And we'll start with the tariffs. So the fate of President Trump's tariffs are in question. The Supreme Court ruled that using emergency powers to declare implement tariffs has been deemed as unconstitutional. But that's not stopping Trump. Following the news, Trump defied the ruling by announcing last time I looked, a new 15% global tariff. Now, at the same time, fears are rising that a strike on Iran is imminent following reports that Trump is considering at least a limited military action. And that's important because the Strait of Hormuz is right off Iran's coast and sees more than 14 million barrels of oil pass through every day, or about a third of global oil exports. And so, as you can imagine, that's exerting upward pressure on oil prices. And a rally in oil prices is hoping to push broad commodity indexes back toward a key level. And you can see that with this chart on here of GSG, which is the iShares S&P GSCI Commodity Index. It's the index tracks a broad commodity basket, but oil gets a heavy weight in that. And what you want to watch for is GSG. The initial level was this 24 area right here. That was the first key level to watch. And we had this breakout above it. Now, price came up to 26. That and rejected off that level. That happens to be the high back here in 2022. And what's happening is you had this short-term pullback consolidation, and now we're rising back up for that level again. So this 26 level is a very, very key area to watch here on GSG in the week ahead. Now, here's another reason why that's important with tracking commodities. It's because there is growing hawkishness at the Federal Reserve. This comes despite expectations that a new incoming Fed chair with Warsh, he's going to be pressuring the FOMC to keep cutting interest rates. But the most recent minutes of the Fed's last rate-setting meeting, it showed that several policymakers are now suggesting higher rates could be needed, not lower rates, higher rates, because inflation is not moderating as expected. In fact, progress on disinflation stalled out a long time ago, and we'll talk more about that here in just a second. And so, again, the rally in commodity prices could threaten more upside pressure on inflation. So this week, what I want to do is look at the elements behind this hawkish shift at the Fed and why inflationary pressures continue building, the evidence that we're getting from the market there. But I also want to come back to the underlying economy. It continues to perform well despite the weaker than expected fourth quarter GDP report. It's not all what it seems, and I'll have a chart on that. And I also want to touch on the historically strong breadth that we're seeing in the stock market. All right, the Fed's most recent meeting continues to indicate a hawkish shift at the central bank. So the meeting, when it happened at the end of January, it was interpreted as a hawkish pause because the Fed voted to keep rates steady, but they also upgraded the assessment of the economy. So less risks, downside risks to the economy, and that's that hawkish pause. But the recently released minutes of the meeting reveals more concern over inflation levels because inflation remains stubbornly high, and we got another look at the Fed's preferred inflation gauge with the Personal Consumption Expenditures Price Index, the PCE. That's showing signs of inflecting higher following the disinflation trend that's really stalled out at the 3% level. So what this does, this takes PCE, the core PCE, so it excludes food and energy prices. And this looks at different annualized period, but the one I would really focus on is this darker blue line, which is the percent change in PCE from a year ago. And in December, that ticked up to the 3% level. Now, what I would pay attention to is a couple things on here. One is that you can see this has been slowly inflecting higher since the start of last year. And this is part of an overall trend where this disinflation trend off the mid-2022 peak, this disinflation trend has now stalled out for a couple years now, and again, showing signs of moving higher. So we want to keep a close eye on that. Here's another thing with to watch with inflationary pressure. So, if we continue to see the broader commodity indexes rally, we've had this big breakout from a bullish consolidation pattern in broad commodity indexes going back several years. So it's a very meaningful breakout in commodities. Well, other areas of the capital markets that are sensitive to inflation are holding up really well. So, I mean, that includes precious metals with gold. Energy stocks you need to keep an eye on as well. So, energy stocks are surging higher. And what this chart does is it plots the percent of the stocks inside the S&P energy sector that are trading above their 50-day moving average, and that figure hit 100% for the first time in over a year. So 100% of the stocks within the S&P 500 energy sector trading above their 50-day moving average. Why do you want to note that? Because energy is among the best performing sectors during periods of high and rising inflation. I think the energy sector is telling you something here. Now here's the other thing. Energy is also looked at as kind of this reflation trade, meaning it's a positive for the economic outlook. But here's the thing. It's also generally positive for the stock market. When you have 100% of the energy stocks trading above their 50-day moving average for the first time in over a year, look at what the S&P 500 does 1 year later on average. 20.5% gain on all these prior instances, a positive win rate every single time. So could be very meaningful signal for inflation, but over the next year, it could be a positive signal for the stock market here as well. All right, the most recent report on economic activity showed a sharp deceleration, and a lot of that was because of the impact of the government shutdown. So the initial look at fourth quarter GDP showed an annualized gain of just 1.4%. It's a sharp drop from the prior quarter. Missed estimates for a 2.5% gain. Now the government shutdown, like back in the fourth quarter, likely accounted for most of that shortfall. But the thing you want to watch is that underlying measures of consumer demand remain strong. So GDP categories like government spending, changes in inventories, they can be very noisy on a quarter-to-quarter basis. And that's what this chart on the right is showing right here. It's showing the impact on real GDP when you look at government spending, net exports, and inventories. And you can see a lot of volatility and variation in that figure on a quarter-to-quarter basis once again. The graph on the left, this shows a better underlying picture of the economy, a better underlying picture of demand by combining personal consumption, so a lot of this is going to encapsulate consumer spending, along with fixed investment. And you can see we grew at a 2.4% annualized pace. This tends to be a more stable data series, when you compare it to the variation of these other GDP components. And while it's while it's a slight drop from the prior quarter, you can see overall in line with what we've seen over the past couple of years. And when you look at GDP components through that lens. All right, cyclical sectors that are sensitive to the economy, they're off to a strong start in 2026. I think that's a positive reflection on the outlook for the economy. And a stronger economy could mean broadening earnings growth that finally starts to get away from the Magnificent Seven and toward the average stock. So the Mag 7 has been a major driver of returns for the S&P 500 ever since this cyclical bull market began in late 2022, and they've earned it. It's a reflection of their earnings contribution. So the chart shows on here from 2023 to 2025, earnings growth for different areas of the market. On this dark blue line, this is the Mag 7. I believe this is the average annual change in earnings, for the Mag 7 pushing toward 25%, easily outpacing what you see with the S&P equal weight, or what it ends up being with the S&P 500 excluding the Mag 7. So Mag 7, a huge driver of the earnings recovery over the last couple years. That's been reflected in their share prices. But look at what happens over the next 2 years. So 2026, 2027, that earnings contribution from the Mag 7 trails off sharply. I mean, it's still a strong growth rate, but all of a sudden you see the average stock in the S&P 500 starting to pull ahead and lead the way. And so you can see that earnings growth in the equal weight, that lighter blue line, is projected to slightly outpace the Mag 7 through the end of next year. Now here's why that's important. So concerns over the AI trade are really starting to weigh here. So we know a lot of AI stocks and mega cap stocks in the S&P 500. I believe every member of the Magnificent Seven is in some way, shape, or form exposed leverage to the AI trade. Well, those stocks are trading with valuations that are well above historical averages. You're seeing a lot of concerns right now with the massive ramp up in CapEx spending by the largest AI hyperscalers, and that's starting to really eat into cash flow. And so we're seeing a lot of these Mag 7 stocks are pulling back, but given their massive weight in the S&P 500, it's weighing on the index as well, but that is masking a really strong rally that you're seeing in the average S&P stock to start the year. On a year-to-date basis, what this chart in here is showing, on a year-to-date basis, approximately 66% of the S&P 500 members are outperforming the benchmark. That is the highest level on record going back to 1986. So, again, looking at this chart, this is the number of members in the S&P 500 that are outperforming the index year to date until that stands around 325, 330 or so. That is the largest number of stocks to be outperforming the index in the history of this data series. And, a big thing to note about that is this broadening rally. It likely reflects that shifting earnings outlook, where the average stock over the next couple of years is projected to grow their earnings at a faster pace than the Mag 7 stock. And I like to say stock prices will ultimately follow earnings. And I believe that's what this broadening out of breadth in the S&P 500 is reflecting. All right, so we got a pretty light week for economic data, but we'll continue to see earnings reports rolling in. And, here's the thing. Everyone's kind of looking at this most recent GDP report. Well, guess what? You're receiving a report on economic activity from the fourth quarter. I mean, it's a lag, a report with a lag on a lagging indicator. If you want to understand, what's happening in real time and what things look like for the earnings picture looking ahead, you want to pay attention to corporate earnings. I mean, again, these are going to be real-time snapshots of what's happening, and whether it's specific sectors or some of these companies have broader exposure to the economy. But names like Home Depot, it's going to be really important for insights into the housing market. We can keep an eye on some of the things that I've liked to track. Some of the things that are working well for us at the Traders Hub in terms of trades are pick and shovels trades leveraged to the AI theme. Along those lines, and nuclear, keep an eye on BWXT, BWX Technologies. So, again, we're through a lot of earnings season, and especially for the S&P 500, but there's a lot of other smaller cap names that are still rolling in. And, if you focus on, if you want to focus on these companies operating in specific end markets, you can get some clear pictures as to how trends are evolving. All right, one trade idea I want to keep an eye on in the weeks ahead is with Royal Caribbean, ticker RCL. And I think this is a really compelling setup if we find support at this 300 level. Here's why. So, we initially had this run up to, you can see a peak around $365. This was back in August, September of last year. And we started this new basing pattern. So here's your larger degree pullback into December. A rally to start the year brought us right back up to that prior resistance level, right around that 365 area. And this is what I want to keep an eye on right here. So we had this gap up toward that resistance level. Now we're getting a smaller pullback. What you want to watch right here, the smaller pullback, it's resetting. We're getting this bullish MACD reset above zero. You want to see price support hold at this $300 level, because that is the price support area from this gap. So if we can see the stock price stabilize and turn back higher right here, that sets up a good potential that we're going to see a breakout to new highs for RCL. All right, that is all for